Whether you're the sole business owner or a shareholder in an incorporated partnership, understanding shareholder loans is essential for making informed financial decisions and maximizing the benefit of your corporate structure. Let's dive into what a shareholder loan is, how to use it, and some of the other important considerations. Hi, I'm Jay Gagnes, and I help make Canadian business owners' goals a reality with innovative financial advice. A shareholder loan is a financial agreement between a shareholder and the company. Shareholder loans come in two forms: when a shareholder lends money to the company and when a shareholder takes a loan from the company. Let's explore these two scenarios in detail. Number one, shareholders lending money to the company. This occurs when a shareholder provides funds to the company through a loan. The shareholder becomes a creditor and the company is the debtor. The loan amount, terms, and conditions are agreed upon between the shareholder and the company. This form of financing can be beneficial for the company's cash flow and expansion plans. It is important to note that there are no tax implications when a shareholder lends its corporation money, and when the company pays the shareholder back, it is paid back completely tax-free. This is often done if a company requires additional cash for financing, a project, or day-to-day operations of the business. I have personally lent my company money several times over the years for multiple things, from day-to-day cash flow to the purchase of real estate. Number two, shareholders taking a loan from the company. In this scenario, the company lends money to one of its shareholders. This can happen when a shareholder requires personal funds for reasons such as covering personal expenses, purchasing assets, or making investments outside of the company. The terms and conditions of the loan are established, including the loan amount, interest rate, and repayment period. Taking out a shareholder loan from your corporation can be advantageous in many situations. Let's jump into a few ways you can use a shareholder loan strategy. Number one, personal cash flow needs. Shareholder loans can be a convenient way to access funds for personal cash flow needs. If you, as a shareholder, require money for personal expenses or investments, a shareholder loan allows you to borrow from the corporation rather than seeking external financing options. Number two, tax planning and deferral. Shareholder loans can be a part of an effective tax planning strategy. By borrowing funds from the corporation instead of taking dividends or salary, you can potentially defer personal taxes on income. This strategy allows you to postpone the recognition of personal income until a later date, potentially reducing your current tax liability significantly. Number three, investment opportunities. Shareholder loans can provide capital for investment opportunities such as real estate, stocks, or a business venture. Borrowing from your corporation can provide the necessary funds without depleting your personal savings or requiring external financing. Number four, cash management and liquidity. Shareholder loans can help manage cash flow and improve liquidity. If the corporation has excess funds, lending those funds to a shareholder can allow for better use of available cash resources. Number five, estate planning and succession. Shareholder loans can be part of an estate planning or succession strategy. If you are transitioning the ownership of your corporation to a family member or other individuals, providing a shareholder loan can assist in the transfer of ownership while maintaining control and ensuring a smooth transition. Number six, flexibility and control. Shareholder loans allow for flexibility and control over the terms and repayment schedule. Unlike external loans from financial institutions, you can negotiate the terms and interest rates directly with the corporation, tailoring the loan to your specific needs and financial circumstances. While there are benefits, both forms of shareholder loans carry risks. In the case of a shareholder lending money, there is a risk of non-repayment by the company, potentially impacting the shareholder's financial stability. When a shareholder takes a loan from the company, it's important to establish clear repayment terms to avoid straining the company's cash flow. Another important consideration are the tax implications. When a shareholder lends money to the company, any interest received is typically considered taxable income. When a shareholder takes a loan from the company, the interest paid may be subject to specific tax rules. Always consult a tax professional to get a clear understanding of the tax implications in your jurisdiction. As always, it's important to note that taking a shareholder loan requires careful consideration and adherence to legal and tax regulations. To avoid unintended consequences, consult with legal and financial professionals for guidance on the appropriate structure, interest rates, repayment terms, and tax implications of a shareholder loan. Shareholder loans can be an incredibly valuable strategy to integrate into your overall financial plan. Having a corporation is just step one. Knowing how to actually use the strategies to maximize the use of your corporation is where the magic really happens. Thank you for watching. Are you ready to achieve your goals with a customized financial plan? Take the first step by booking a call with the link in the description below.